There is one thing I want to tell you before we get into anything else. It is something I wish someone had said to me about 10 years ago, and it is this. If you have ever felt behind with money, not reckless, not irresponsible, just somehow not as far ahead as you should be given everything you have done right, that feeling is not a character flaw. It is a very accurate reading of a system that was not built with you in mind. Most financial content in this country was built around a set of assumptions it never names out loud. A continuous full-time career, no interruptions, super contributions that never pause, and a salary that grows in a straight line. When you apply that advice to a working life that includes any of those things, a career break, part-time work, a salary reset, it does not fit. That is not a discipline problem. The framework was missing the variables that matter most for you. This video is a different map, built specifically for the way money actually works in Australia. Your super, your tax, your career, the breaks and resets a real working life includes, and the decisions that are going to matter most in the next 10 to 20 years. We are going to move through the whole picture: pay and tax, super, debt, investing, property, and the life stage decisions that quietly change every other number on the list. This is the video I am going to link to from every other video on this channel because it is the foundation everything else builds on. There is one thing I will come back to at the very end. A specific action that most Australian women have never taken, not because they are bad with money, but because nobody ever told them it existed. It will take you about 10 minutes. But first, let's start at the beginning. Chapter 1. Your income. Understanding the actual numbers. The foundation of every financial decision you will ever make is understanding your actual numbers. Not your rough numbers, not the number you tell people when they ask what you earn. Your actual numbers. And most people, most smart, competent, financially engaged people, are working from the wrong ones. Here is what I mean. There is a woman I want you to think about. Let's call her Priya. Priya is 33. She works in marketing in Sydney, earns $92,000 a year, and by most measures she has her head screwed on. She has a savings account she contributes to every month. She has a super fund. She does not carry credit card debt. And yet every time Priya sits down to think about her financial situation properly, the numbers do not add up the way she expects. She feels like she should be further ahead. She is not sure why she isn't. The first thing I would ask Priya is this: what is your net pay? What actually lands in your account each fortnight? And then, what is your effective tax rate? Not your marginal rate, your effective rate. The amount of tax you actually pay as a proportion of your total income. Most people know their gross salary. Almost nobody knows their effective tax rate off the top of their head. And the gap between those two numbers, the gap between what you earn on paper and what the system takes, is where most financial plans start to fall apart, because people are building budgets and projections on the wrong starting number. Here is how Australian income tax actually works. The tax system is marginal, which means different portions of your income are taxed at different rates. In the 2025 to 2026 financial year, the first $18,200 you earn is tax-free. The next portion up to $45,000 is taxed at 16%. From $45,000 to $135,000, the marginal rate is 30%. Above that, it rises further. If Priya earns $92,000, her marginal rate, the rate that applies to the last dollar she earns, is 30%. But her effective rate, the rate she actually pays across her whole income, is significantly lower because the lower portions of her income were taxed at lower rates. Her effective rate sits closer to 22% once you factor in for the Medicare levy. Why does this matter? Because if Priya is making decisions about salary sacrifice, about voluntary super contributions, about investing, using her marginal rate as her actual tax burden, she is overestimating the cost of those decisions and underestimating the benefit. It leads to real errors. It is one of the most common and most consequential mistakes I see in the way people think about their money. Now, superannuation. Because there is something about how super works that a surprising number of people, including people who are genuinely on top of their finances in other respects, either do not know or have never properly internalized. Your employer's super contribution does not come out of your take-home pay. It is paid on top of your salary. The current super guarantee rate is 12%. So if Priya earns $92,000, her employer is contributing an additional $11,040 into her super fund on top of that. Money she never sees in her pay packet. Money that never touches her bank account. Money that is working quietly in the background, whether she thinks about it or not. The reason this matters is that it changes how you think about salary sacrifice. When you salary sacrifice, when you ask your employer to redirect some of your pre-tax pay directly into super, you are not taking a pay cut in the way it might feel. You are redirecting money that would otherwise be taxed at your marginal rate into an environment where it is taxed at 15% instead. For Priya, at 30%, that is a 15 percentage point difference on every dollar she salary sacrifices. That is not a rounding error. That is a meaningful, compounding, long-term advantage that she currently is not using. So that is the mechanical case for salary sacrifice. We will come back to it in the super chapter with the specific numbers. For now, the point is simply this. You cannot make good decisions about salary sacrifice or voluntary contributions or investment strategy if you do not know your effective tax rate. It is the denominator in almost every calculation that follows. The last thing I want to cover in this section is the gender pay gap, because it is relevant to everything downstream, and because the number most people have in their heads is wrong. The WGEA, the Workplace Gender Equality Agency, publishes the National Gender Pay Gap annually. The most recent figure is 16.4%, measured on median total remuneration. That means the median Australian woman earns 16.4 cents less for every dollar the median Australian man earns when you account for total pay, including bonuses and allowances, not just base salary. 16.4%. Not the 5 or 6% some people quote. Not the 2 or 3% that gets cited when someone wants to argue the gap is closing. 16.4. That figure matters not just because it represents a real and present difference in income, but because of what it compounds into over time. A $10,000 gap in annual salary at 30, applied across a 35-year career with standard pay rises, does not stay at $10,000. It grows. It grows in income, in super contributions, in investment capacity, and in the retirement balance at the end of all of it. The gap you are sitting inside right now is not just a number on this year's payslip. It is a number that is compounding quietly in the background. Every year, you do not close it. Which brings me to negotiation. I am going to be brief here because there is an entire separate conversation to have about this. But the relevant point is this. Women in Australia are statistically less likely to negotiate salary at the point of hire than men. Not because they are less capable of it, because they have been socialized to treat the offer as a given rather than as an opening position. The research on this is consistent. A $5,000 negotiation win at 28 does not just add $5,000 to your income. It resets your base salary. The number every future raise is calculated from. Upward for the rest of your career. It adds to your super contributions every year. It changes your borrowing capacity. $5,000 at 28, compounded through a career and into super, is not $5,000. It is a multiple of that. Negotiate. The action for this chapter is simple. Open your most recent payslip and find 4 numbers: your gross salary, your net pay, what actually lands in your account, your super contribution, the amount your employer is paying on top, and your effective tax rate. Total tax paid in the last financial year divided by your gross income. If you do not have your tax return handy, an approximate figure is fine. Write those 4 numbers down somewhere. Every other chapter in this video assumes you know them. Chapter 2, Superannuation, the quiet wealth engine. If there is one chapter I want you to stay with, it is this one. Not because it is the most exciting. It is not. But because it is the chapter where most Australian women are leaving the most money on the table, often without realizing it, and where a handful of specific decisions in your 30s can change the number at retirement by hundreds of thousands of dollars. Let me start with where most people start, which is, how does super actually work? Your employer pays 12% of your salary into a superannuation fund on your behalf. That money is invested in shares, property, bonds, or a combination, depending on which investment option your fund uses and whether you have ever chosen one, and it grows over time in a tax-advantaged environment. Inside super, investment earnings are taxed at 15%. Outside super, those same earnings would be taxed at your marginal rate, up to 30 or 45%, depending on your income. That difference is the entire reason super is so powerful as a wealth building vehicle. It is not magic. It is tax arbitrage built into the system, available to everyone. The money your employer contributes is called the concessional contribution. The annual cap, the maximum that can go into super from pre-tax sources, including both employer contributions and any salary sacrifice you add, is $30,000 per year for the 2025 to 2026 financial year. Now here is the problem, and it is a significant one. The average Australian woman reaches retirement with approximately $56,500 less in super than the average man. The pay gap is part of it, but it is not the main driver. The larger causes are structural, career breaks that pause contributions, part-time work that reduces them, and the compounding loss of money that was never invested at 32, and therefore was not there to grow at 42 or 52 either. Let me show you what that actually looks like. Priya takes 14 months off when her first child is born. During that time, her employer is not required to pay super on wages she is not receiving. The government now pays super on its own parental leave payments, a change that came into effect from July 2025. But Priya's employer does not top that up voluntarily beyond what is required. So for portions of her leave, the contributions stop. She comes back part-time, 3 days a week for 4 years while her daughter is in primary school. Her super contributions during those years run at roughly 60% of what they would have been full-time, because the contribution is a percentage of salary paid. None of that is unusual. None of it is reckless. It is a completely normal working life for an Australian woman in her 30s. And here is what it costs her. At 7% annual growth, a conservative long-term assumption for a diversified investment option. Money that sits uninvested for 14 months does not just miss 14 months of contributions. It misses 14 months of compounding on everything already in the account. If Priya had $80,000 in super at 33 when she went on leave, that pause costs her not just the contributions she did not receive. It costs her the growth on those $80,000 that did not happen, and then the growth on that foregone growth, compounding forward to retirement. Then add 4 years of part-time contributions running at 60%. Every year of reduced contributions is another year where the gap between what is in Priya's account and what would have been there widens. The money that was not invested at 35 does not exist at 55. This is the mechanism behind the super gap, not poor financial decisions, not disengagement. A system that calculates contributions as a percentage of salary paid, applied to a working life that includes interruptions the system was not designed around. So what can you actually do about it? Quite a lot, as it turns out. There are several specific levers, most of which are almost entirely unclaimed by the women they were designed for. The first is your investment option. Most Australians are in their super fund's default investment option. The default is usually a balanced or moderate option, designed to minimize short-term volatility, which sounds sensible, but which typically produces lower long-term returns than a growth or high-growth option. If you are under 50, you have a long enough time horizon to absorb short-term market movements. Switching from a balance to a high-growth option in your 30s can make a material difference to your balance at retirement. Log into your super fund and check what you are in. If you have never chosen an option, you are almost certainly in the default. The second is consolidation. About 1 in 5 Australians has more than one superannuation account, and every extra one is charging fees. Fees that are, in many cases, a flat dollar amount per year regardless of your balance, which means the smaller accounts are being eroded disproportionately fast. Find all your super accounts through MyGov linked to the ATO. It will show you every fund that has ever been opened in your name. Consolidate into one. The ATO also holds $21.5 billion in unclaimed superannuation as at February 2026, money contributed by employers over the years that lost contact with its owner. Some of it is almost certainly yours. The third, and the one most people skip entirely, is your binding beneficiary nomination. Your superannuation does not automatically form part of your estate. It sits outside your will. If you die without a current binding nomination, your super fund's trustee decides who receives your balance, not your family, not the instructions in your will. The trustee. Most people have never nominated anyone or nominated someone years ago during a different life stage and never updated it. This takes 10 minutes. It is one of the most important financial documents you will ever complete. We will come back to this at the end of the video. Beyond those three, there are 2 government schemes worth knowing that almost nobody in the position to benefit from them is actually using. The first is the Super Co-contribution scheme. If you earn under approximately $47,500 in a financial year, any year you are on parental leave, working part-time, or returning from a career break, and you make a voluntary after-tax contribution of $1,000 into your super, the federal government will deposit $500 directly into your super account on top of it. Automatic. No application. When you lodge your tax return, the ATO calculates it, and the payment appears in your fund. $1,000 in, $500 added. Most women who qualify for this in a given year never make that voluntary contribution, which means the government match never triggers. Now you know it exists. The second is the low income super tax offset. If you earn $37,000 or less in a financial year, the ATO automatically refunds the 15% tax your employer already paid on your super contributions, up to $500, directly back into your super when you lodge your return. You do not need to do anything to receive it. What is worth knowing is that it exists at all, so that in any year your income drops below that threshold, you can log into your super fund after tax time and confirm it has landed. We are about halfway through. If you need to pause and come back, this is a good place to do it. The second half is debt, investing, property, and the life stage decisions that change every other number on the list. Stay with me. Chapter 3. Debt. Most people manage their debt the way they manage their inbox, by feel, by what is most visible, and occasionally by what is causing the most anxiety that week. Some people tackle the biggest balance first, because clearing a large number feels like progress. Some people pay off the smallest debt first because they want the psychological win of making something disappear. Some people prioritize the debt that feels the most legitimate, the home loan, the HEX balance, and ignore the others. None of these approaches are wrong exactly. They are just expensive. There is a better method. It is not complicated. Rank every debt you hold by interest rate, highest to lowest, and direct every extra dollar toward the debt at the top of that list until it is gone. Then move to the next one. That is it. This is called the avalanche method, and the mathematics behind it are not subtle. You are minimizing the total interest you pay over the life of your debts by eliminating the most expensive ones first. Size does not matter. Emotional weight does not matter. Interest rate is the only variable that matters when you are trying to get out of debt as efficiently as possible. Let me walk through what a ranked debt stack typically looks like for an Australian woman in her 30s, using Priya as the example again. Priya has 4 debts. A credit card with $6,000 on it at 19.9%. A car loan with $11,000 remaining at 11%. A HEX balance of $28,000 with the new indexation rate of 2.8% being applied on the 1st of June 2026. And a mortgage she is planning to take out in the next 2 years, which, for the purposes of this framework, we will treat as a future debt rather than a current one. By interest rate, the ranking is obvious. Credit card first, car loan second, HEX a distant third. But here is what most people do. Most people look at that HEX balance. $28,000, no bank involved, no collector calling, indexed to inflation rather than charged a punishing rate. And they throw extra money at it because it feels clean. It feels like a real debt being properly addressed. Meanwhile, the credit card sits at 19.9%, compounding every single month on a balance they are making minimum payments on. The maths on that decision is stark. Every extra $100 Priya puts toward her HEX instead of her credit card costs her the difference between 2.8% and 19.9% on that $100. Every year until the credit card is gone. The cleanliness of HEX is an illusion. It is the cheapest debt on her list by a significant margin. It can wait. One note on HEX that is worth being clear about. It is not interest-free. It is indexed annually, applied on the 1st of June. Since 2023, the indexation rate is the lower of the Consumer Price Index or the Wage Price Index, a change designed to stop the debt growing faster than wages. The new rate being applied on the 1st of June is 2.8%. In 2023, it was 7.1%, which caught a lot of people off guard. So it is not a zero-cost debt, but at 2.8%, it is still the cheapest debt most people carry. The ranking holds. The other debt worth naming specifically is the mortgage, or for those who do not yet own property, the offset account. For homeowners, an offset account is one of the most efficient financial tools available in Australia. Every dollar sitting in your offset account reduces the balance your mortgage interest is calculated on. If your mortgage rate is 6% and you have $20,000 in your offset, you are saving 6% interest on that $20,000. Tax-free, because it is a reduction in interest rather than investment income. At current mortgage rates, that effective return beats most savings accounts. If you own a home and have savings sitting in a transaction account earning 2% while your mortgage charges you 6%, moving that money into an offset is one of the simplest and highest return financial decisions you can make today. The action for this chapter is simple. Write down every debt you currently hold, the lender, the current balance, and the interest rate. If you do not know the interest rate on one of your debts, look it up before you do anything else. Rank the list from highest rate to lowest. That ranked list is your debt priority order. Every dollar above your minimum payments goes to the one at the top until it is gone. Then you move down. Chapter 4. Investing. Now let us talk about investing, because one of the most common things I hear is some version of, I will start investing once I've sorted out my debt, or once I've bought a house, or once things settle down a bit. And I understand the instinct. It feels responsible, sequential, like you are building on a solid foundation before adding the next layer. The problem is that investing is not the next layer. It is a parallel track. And the cost of waiting until everything else is resolved is not abstract. It is years of compounding that you do not get back. Here is the honest framing on the debt versus investing question, because it is not as simple as pay everything off first or always invest regardless. The answer depends on your interest rates. If your debt is costing you more than your investments are likely to return, pay the debt first. A credit card at 19.9% is a guaranteed 19.9% return every time you pay it down. No market risk, no volatility, no waiting. No investment vehicle offers that with certainty. So yes, clear your high-interest consumer debt before you start building a portfolio. But once your expensive debt is gone, the calculus changes. A HEX balance at 2.8% or a mortgage at 6% on which you already have an offset working. These are not compelling reasons to delay investing. A diversified share portfolio has returned roughly 10% per year on average over the long term, before inflation. Waiting until your mortgage is paid off to start investing could mean waiting until your 50s to begin a process that benefits most from starting as early as possible. The rule is this: if your debt's interest rate is higher than what you can reasonably expect to earn from investing, clear the debt first. If it is lower, there is a real case for doing both at the same time. So, what does investing actually look like in practice for someone starting from scratch? The entry point for most Australians, and I want to be clear that this is not the only path, but it is the most accessible one, is a low-cost exchange-traded fund, or ETF. An ETF is a single investment that holds a basket of assets, typically tracking an index. The 200 largest companies on the Australian Stock Exchange, for example, or a global index covering thousands of companies across dozens of countries. When you buy one unit of an ETF, you own a small slice of everything inside it. You are diversified from the first purchase. You do not need to research individual companies or make active decisions about which stocks to hold. You buy the index, and the index, over time, has consistently gone up. The management fees on index ETFs in Australia are low, typically between 0.07% and 0.2% per year. That means for every $10,000 you invest, you are paying between $7 and $20 annually in fees. Compare that to actively managed funds, which often charge 1% or more and, on average, underperform the index they are trying to beat. The fee difference compounds over decades in your favor. The practical approach for someone building a portfolio for the first time is dollar cost averaging. You choose an amount. It does not have to be large. It could be $200 a month. And you invest it on a fixed schedule, regardless of what the market is doing. When prices are high, you buy fewer units. When prices are low, you buy more. Over time, this averages out your purchase price and removes the impossible task of trying to time the market. It also removes the emotional component. You are not deciding each month whether now is a good time to invest. You have already decided. The transfer is automatic. The purchase happens. You move on. On the tax side, there are two things worth understanding as an Australian investor. The first is dividend taxation. When the companies inside your ETF pay dividends, those dividends are passed through to you and taxed as income at your marginal rate. However, many Australian companies pay franked dividends, dividends that come attached to a tax credit representing the corporate tax already paid on those profits. Those franking credits offset the tax you owe on the dividend, sometimes eliminating it entirely. This is a feature of the Australian tax system that does not exist in the same form anywhere else, and it is genuinely valuable. The second is the capital gains tax discount. If you sell an investment and make a profit, that gain is added to your taxable income in the year you sell and taxed at your marginal rate. Currently, if you held the investment for more than 12 months before selling, you are entitled to a 50% discount on that gain. So on a $10,000 profit, you are only taxed on $5,000 of it. That rule is changing. From the 1st of July 2027, the flat 50% discount is being replaced with an inflation-adjusted calculation and a new 30% minimum tax on gains. There are several platforms available in Australia for buying ETFs directly. Vanguard Personal Investor, Perla, and CommSec Pocket are commonly used starting points. What to look for when comparing them: the brokerage fee per transaction, whether there is an ongoing account fee, and the minimum investment amount. For someone starting small, these details matter more than they do once you are investing larger amounts. One thing also worth looking for: CHESS sponsorship. CHESS is the ASX system that records share ownership. A CHESS-sponsored account means your shares are registered directly in your name with the exchange. Some platforms use a custodian model instead, where the platform holds the shares on your behalf, which means if that platform were to collapse, your shares are not legally yours in the same direct way. For most people starting out, the fee difference matters more day to day, but CHESS sponsorship is the safer structure and worth prioritizing where fees are comparable. I want to say one more thing before we leave this chapter, and it is something I touched on in the super section, but is worth naming again here. You are already an investor. Your superannuation account is an investment portfolio. The option you are in, whether you chose it or defaulted into it, is invested in a mix of shares, bonds, property, and cash. For most Australians, super represents their single largest investment. If you have $100,000 in super and $2,000 in a brokerage account, your most important investment decisions are the ones you are making inside your fund, not outside it. Get the super right first, then build the portfolio alongside it. The action for this chapter: if you do not have an investment account outside of super, open one and make a single purchase. It can be $500. It can be $200. The amount matters less than the act of starting. But do not stop there. Set up an automatic transfer so that the same amount hits that account on the same day every fortnight or month, without you having to decide. The first transaction removes investing from the category of things you are planning to do and puts it in the category of things you do, and the automation keeps it there. Chapter 5. Property. Very few topics carry more emotional weight in Australia than property. Owning a home is not just a financial decision here. It is framed as a milestone, a marker of adulthood, a sign that you have your life properly together. Renting is spoken about as though it is a temporary condition, something you endure on the way to the real thing. That framing is worth examining because it leads a lot of people to make very expensive decisions based on social pressure rather than numbers. Let me give you the numbers first, and then we will talk about what to actually do with them. The median dwelling value to income ratio in Sydney right now is 10.0 times. In Melbourne, it is 7.1 times. What that means in practice, the median property in Sydney costs 10 times what the median income earner makes in a year. A decade ago, that ratio was closer to 6 or 7. The idea that property ownership is the default, obvious, responsible financial choice for an Australian woman on a single income in a capital city needs to be held up against those numbers and examined honestly. That is not an argument against buying. It is an argument for being clear-eyed about what you are actually deciding and why. The real cost of buying a property is not the purchase price. It is the purchase price plus stamp duty, which in New South Wales on a median priced property runs into the tens of thousands of dollars, plus legal and conveyancing fees, building and pest inspections, lender's mortgage insurance if your deposit is below 20% of the purchase price, and then ongoing costs once you own it. Budget 1 to 2% of the property's value per year for maintenance and repairs. Add strata fees if it is an apartment. These numbers do not appear in the glossy property brochures, and they rarely appear in the excited conversations people have about how much their property is worth. They are real costs that need to be in your calculation before you decide whether buying is the right move. On borrowing capacity, what a bank will actually lend you, the key variables are your income, your existing debts, your deposit size, your living expenses, and your credit history. One thing that catches a lot of women off guard is how HEX affects this. Your HEX balance does not reduce your borrowing capacity in the same way that a credit card balance does. But your HEX repayment obligation does reduce your net income in the bank's assessment because they are calculating how much disposable income you have available to service a mortgage. A $28,000 HEX balance repaying at several $1,000s per year reduces what the bank thinks you can afford to borrow. There is also a timing trap that is almost never discussed, and that I want you to know about before you sign anything. Australian banks assess your borrowing capacity using income averaging. They look at your income over the last 12 to 24 months, not just what you are earning now. If that window includes a period of parental leave, a career break, or significant part-time work, your assessed borrowing capacity will be lower than your current salary suggests. This disproportionately affects women because women take the majority of parental leave in Australia. If you are planning to buy and also planning to have children, or if you took leave recently and are now back full-time, the timing of your mortgage application relative to that income history matters more than most brokers will tell you upfront. If you are a first home buyer, the first home guarantee is worth knowing about. It allows eligible buyers to purchase with a 5% deposit without paying lender's mortgage insurance, which on a median price property can save you tens of thousands of dollars. As of October 2025, the income caps and the cap on the number of places have been removed entirely. Only the property price caps still apply, and they vary by state and region. Check the current thresholds at housingaustralia.gov.au before you assume you qualify. For women who are priced out of buying where they live but want to get into the market, rent vesting is increasingly worth considering. The structure is straightforward. You buy a property in a more affordable location, regional New South Wales, a different city, wherever the numbers work, and rent it out while continuing to rent yourself in the city where you actually want to live. You build equity and get the tax benefits of owning an investment property without committing to living somewhere that does not suit your life. It is not the right structure for everyone, but for single income women in Sydney or Melbourne who have a deposit but cannot make the numbers work on a purchase where they live, it is a real option that is worth modelling properly. The action for this chapter: if you are planning to buy in the next 2 years, do 2 things. First, run your borrowing capacity through a bank's online calculator using your actual income and your actual existing debts, not an optimistic version of those numbers. Second, check whether you qualify for the first home guarantee at housingaustralia.gov.au. Know your real number before you sit down with a broker, because a broker who knows you do not know your number is not always working in your interest. Chapter 6. Life Stage Decisions. There is a category of financial decisions that almost never appears in mainstream money content, and it is the category that matters most for Australian women. Not which ETF to buy, not whether to fix your mortgage rate. The decisions that change everything are the ones bound up in how you live. When you have children, how long you take off, whether you go back full-time or part-time, and how your finances are structured inside your relationships. These are life stage decisions, and they have a longer financial tail than almost anything else on this map. Let us start with parental leave, because the financial picture here is more complicated than most people realize going in. When you stop working to care for a child, whether for 4 months or 14, several things happen at once. Your income drops, sometimes to zero. Your super contributions pause or reduce because they are calculated as a percentage of salary paid. And compounding stops working on the contributions that would have been made during that period. The money that is not invested at 33 is not there to grow at 43 or 53. We covered the mechanics of this in the super chapter. What I want to add here is the other side of it, what you can actually do during those years to partially offset the impact. In any financial year where your income drops below approximately $47,500, you may be eligible for the government super co-contribution. Make a voluntary $1,000 contribution into your super, and the government adds $500 on top. If your income drops below $37,000, the low-income super tax offset will also be applied automatically. These two mechanisms were designed exactly for years like parental leave and part-time return. Use them. Now, the childcare decision. This is one of the most financially significant decisions an Australian family makes, and it is almost always made with incomplete information. The default framing tends to go like this: childcare is expensive, therefore staying home saves money. That calculation is incomplete in two ways. First, it ignores the long-term cost of a career pause, not just the income gap during the pause, but the compounding effect on super, the potential impact on career trajectory and future earning capacity, and the difficulty of re-entry after several years out of the workforce. Second, it often ignores the childcare subsidy, which significantly reduces the actual out-of-pocket cost for most families. The CCS, childcare subsidy, is income tested and activity tested. The rate you receive depends on your combined family income and how many hours of approved care you use. For many families, particularly those in lower to middle income brackets, the subsidy covers a significant portion of the cost. The calculator is available at education.gov.au. Run your actual numbers through it before making a decision about whether to return to work, because the choice often looks very different once you know what childcare will actually cost, rather than what you assume it will cost. I'm not making an argument for returning to work over staying home. Both are valid choices, and there are factors that have nothing to do with money. What I am arguing for is making that decision with the real numbers in front of you. Not an assumption, not what someone told you, not a figure that has not been updated since your colleagues' kids were in care 3 years ago. One more thing on this topic, and it is the one that tends to land hardest. If you are in a relationship and one partner reduces their career significantly to take on the majority of care work, which in Australia is still predominantly women, the financial exposure sits almost entirely with that person. Their income reduces, their super reduces, their career capital reduces, their financial independence reduces. If the relationship ends, and roughly 1 in 3 do, the person who stepped back carries a disproportionate share of the long-term financial consequence. This is not an argument against stepping back. It is an argument for structuring it with your eyes open. That means both partners understanding clearly what the financial impact is. It means the working partner making additional super contributions on behalf of the caring partner where possible. You can contribute to a spouse's super account and receive a tax offset for doing so. It means maintaining individual financial accounts alongside joint ones. And it means having an explicit conversation about how you would each exit the arrangement if you needed to, and what that would look like financially for both of you. That conversation feels uncomfortable. The absence of it is more expensive. On career pivots and salary resets, if you change industries or take a significant step back in income in your 30s, know that the salary you are on at 35 is the base from which every future raise, every super contribution, and every investment decision is calculated for the next 30 years. That is not a reason not to make the change. It is a reason to make it with full awareness of the number, rather than finding out what it cost you a decade later. The action for this chapter is a relationship one, regardless of whether you are in a partnership or not. If you are, do you know the balance in your partner's super account right now? Do you know what your combined assets look like and how they are structured? If you were to separate today, would you know where everything is? If the answer to any of those is no, that is the work. Not because anything is about to go wrong, but because financial visibility inside a relationship is not distrust. It is due diligence on your own financial life. Chapter 7. Building the architecture. Now let us put the whole map together. Every chapter we have covered, income, super, debt, investing, property, life stage decisions, operates as a separate layer. Most people manage each one reactively, in isolation, when it becomes urgent. What separates the women who build real wealth from the ones who stay stuck is not better information. It is a system, a deliberate structure where every dollar has a role, and that structure runs whether you are paying close attention or not. The architecture I want to give you has 3 layers, not because 3 is a magic number, but because 3 maps cleanly onto the 3 time horizons your money needs to work across: short, medium, and long. The first layer is your buffer, 3 to 6 months of essential living expenses sitting in a high-interest savings account, not touched unless something goes genuinely wrong. The job of this money is not to grow, it is to protect everything else. Without a buffer, the first unexpected expense, a car repair, a medical bill, a period of reduced income, comes out of your investments or goes onto a credit card. Either outcome sets you back. The buffer exists so that your long-term money never has to absorb a short-term shock. The second layer is your medium-term account. This is money with a purpose and a horizon of roughly 2 to 7 years. A house deposit, a parental leave fund, a career change reserve, a sabbatical. Whatever your next significant life decision is likely to require financially, this is where you build toward it. It earns more than a transaction account but sits outside your investment portfolio because you may need it on a timeline that does not allow for market volatility. A high-interest savings account or a term deposit works well here depending on your timeline. The third layer is long-term growth. This is your super, which is already running whether you are paying attention to it or not, plus any investment portfolio you build outside of super. The job of this money is to compound over decades. It should not be touched for short-term needs. It should not be the account you raid when layer 1 runs dry. Its only job is to grow. Most people have some version of layers 1 and 2, even if they have never named them that way. What most people are missing is the deliberate separation, the clarity about what each pool of money is for, so that a short-term need does not accidentally consume long-term growth. Once you have the structure, the second principle is automation, not discipline, not willpower, not checking your budget every Sunday morning. Automation. On the day your salary lands, money should move. A fixed amount into your buffer or medium-term account before you have touched any of it. A fixed amount into your investment account outside super. Your salary sacrifice, if you have set it up, already leaves before your pay hits your account. The point is that by the time you are looking at your transaction account and deciding what to spend, the important allocations have already happened. You are not relying on yourself to make good decisions at the end of a long week, when your balance is higher than it usually is, and the temptation to spend it is real. The system has already made the decisions for you. This is not a new idea. It is the same logic behind super itself. Employer contributions are automated, precisely because the research showed that when people had to actively decide to contribute, most of them did not. Automation removes the friction. It removes the decision fatigue, and over a 30-year period, it removes the single biggest risk to your wealth, which is not market crashes or bad investments. It is the months where you meant to invest but didn't get around to it. The sequence, if you are starting from scratch or restarting after a period of not paying attention, open a high-interest savings account if you do not already have one, and set up an automatic transfer from your salary into it. Consolidate your super accounts into one fund and choose your investment option. Set up salary sacrifice if your employer offers it, even at a small amount to start. Open a brokerage account and make your first ETF purchase. Set up an automatic recurring investment so that the same amount goes in every fortnight without you having to log in and decide. In that order, one step at a time. You do not need to do all of it this week. You just need to start now. I told you at the beginning of this video that there was one thing I would come back to, One action that most Australian women have never taken, not because they are disengaged or careless, but because nobody ever sat them down and explained that it existed or why it mattered. Here it is. Your superannuation does not form part of your estate. It sits outside your will. If you die without a current, valid binding beneficiary nomination on your super account, the trustee of your super fund decides who receives your balance, not your family, not the person you would have chosen. The trustee, using their discretion, guided by legislation but not bound by your wishes. Your super balance at retirement could be your single largest asset. And right now, if you have never made a binding nomination, or if you made one years ago and have not updated it since your life changed, there is no guarantee it goes where you intend. Log into your super fund today. Find the beneficiary nomination section. Check what it says, or whether it says anything at all. If it is outdated or missing, update it. A binding nomination in most funds needs to be renewed every 3 years. Some funds now offer non-lapsing options, which are worth choosing if your fund offers them. This takes 10 minutes. It is one of the most important financial documents you will ever complete, and it is sitting there undone for most of the women watching this. Do it tonight. And then, for everything else we covered today, I have built a workbook to go with this video. Your effective tax rate, your super gap, your debts ranked properly, your investment projections, I've built into one workbook, so you never have to set any of it up yourself. 157 formulas, already done for you across 9 tabs. You simply type in your real numbers, and the maths runs in the background. It shows you your true take-home pay, what salary sacrifice would actually do to your retirement, which debt to attack first when you rank them properly, and what your monthly investing becomes over 20 years. All of it built for Australian tax, Australian super, and Australian property. By the time you reach the last tab, you'll know exactly where you stand and exactly what to do about it. It is the closest thing I can give you to sitting down and doing this with me. Thanks for staying with me until the very end. If anything in this video changed how you think about something, subscribe. I post every week. See you in the next one.